Hello, I'm Edwin de Jong, analyst from Edison Group, and I'm happy to introduce Sif Group to you. We are joined here today by Sif CEO Fred van Beers. Warm welcome.
Thank you, Edwin.
Mr. van Beers, could you please describe briefly how investors should look at Sif? What does your company do exactly, and what is your place in the energy transition? What should we be aware of?
Yeah, I think what's important to say is Sif has been in the energy offshore wind market for over 20 years now. We have a market share of just over 35%, and what we do is we produce the foundations for offshore wind turbines at sea. So basically, it's a steel construction that is put into the seabed, bridges the water depth, and is about 10 meters coming out of the water, about 10 meters coming out of the water. It's the yellow part that you normally see on pictures. And what's interesting to know is that these monopiles are unique for every individual spot in the field. So instead of building commodity products, we're really building one-offs in series production for one wind farm per time. What I think is important to know is that, as I said, the market share, the unique position we have, and we are based in Rotterdam, Maasvlakte, where we are building a new factory. I guess we come back to that later, in order to make sure that we stay on pole position from a market share perspective, but also from a quality perspective, and in order to be able to deliver our foundations also for the future bigger turbines that are being sold today.
Okay, thank you. And what are the highlights for 2023 so far for Sif?
I think the biggest highlight we have for 23 is the fact that we were able to take a financial investment decision, a positive one, on a new factory, a factory plan that we've been working on for 4 years now, taking into account the bigger turbines and the future market demands coming to us. So that was a big one. It's a 330 million investment that we're at this moment spending and actually building. Secondly, I think it's good to know that we have, like before, been able to deliver on time with the right quality without any delays. The foundations for Dogger Bank B and A, and like also Roermond J and Hydrate transition pieces. So while building a new factory, I would say the highlight as well is that we are able to maintain our production flow in line with commitments to the customers.
Trend seems to be that the wind turbines and the rotor blades, they are getting bigger and bigger. I can imagine that has implication for your company. What kind
Absolutely,
of...
yes. It's a very important point, and that was a strong element in our analysis for this new factory, because 330 million is basically the value, or even more than today's value of the whole company. So in order to build such a thing, we had to make sure that we are building the right factory, and the biggest driver here was the turbine growth. As we can't predict, since this business is developing so quickly, how long the present platform of 15 to 18 megawatt will last, we have put an explicit demand in our financial investment model that we should be able to get a return on our investment within 3, maximum 4 years, because of this fast growing turbine size. So we say, and that we have underpinned with the right pricing and right volume commitments from our launching customers. We can go in detail a little bit later, but yes, we see the development of the size of turbines as one of the bigger issues in this market, and we are very open actually and very clear in pushing towards developers and policymakers. But we believe that for a certain period, it's probably the best to sort of limit the turbine size growth, so that we can optimize the supply chain in order to build the high ambitions from especially the European Union with respect to offshore wind and renewable in general.
And then, although we are in this transition towards clean energy, that there has been a mounting pressure on offshore wind projects recently, so postponements.
Yeah.
How does that-
Yes, definitely. And I think we have to be a bit more specific here. We've seen in the papers very negative messages coming out of the US, I would say mainly, whereby projects are being cancelled in a very far stage of actually being built already. At least the suppliers are building their products. Because of the fact, I would say two reasons. One is the fact that developers have agreed energy prices 2, 3, maybe even 4 years ago, based on the at that time valid prices, construction prices. In the meantime, we have seen this unfortunate war developing in Ukraine and the pressure on base material supplies. So the interest rates have gone up dramatically, but also the supply chain cost prices have gone up dramatically, leaving the developers in a situation whereby actually the energy price they get long term for these projects is too low in relation to the construction and also the operation and maintenance cost of these wind farms. And that has led in the US to a situation that programs have been cancelled. In the UK, I think it's more a one-time glitch, I would say. Their CFD5, so the auction round of last autumn, was a total disaster, simply because of the fact that the government has set an energy price far too low for developers to make a sound business case in developing a wind farm. Yesterday's announcements on the CFD6 that will be opened in March are very promising. The government has raised the energy price with 66%, and now the energy price for that auction round is really at a, I would say, healthy and realistic level in order to turn that auction into a success. So I feel the UK is on a very positive path now again. And then thirdly, the EU, mainland EU, and for example, the Netherlands, the German sector, Danish, etc., they have a different model. And that model is a lot more robust. And you don't see actually any delays or cancellations or threats of cancellations even in that area, if excluded from what we see as a risk, the negative bidding process that has been developed in Germany and is now also part of the IJmuiden Ver tender for the Netherlands, which could be a risky one because that leads to a situation that developers not only have to pay for the project but also have to bring money to the government to actually make that development come true, and that could be a risky one.
Yeah, very, very clear. In the meantime, you're expanding capacity in Rotterdam. I've seen that for myself. Could you elaborate a little bit on what that will mean for Sif in terms of market position, capacity, maybe finance?
It's quite an exciting one. I think I said it before, but we have spent 4 years developing that one. We took a total different approach in developing that factory because this business so far has been ramping up based on basically oil and gas production technology for one-off jackets, a business for monopiles in bigger series. We've taken the more, I would say, automotive approach in really taking the new factory from a process point of view. So it's a complete different setup. It will allow us to ramp up the output from a steel tonnage perspective from 200 kilotons towards 500 kilotons. So it's a 2.5 times bigger output. And we will be able to make monopiles, 200 a year, for 15 to 18 megawatt turbines, so significantly bigger, at a diameter of 11 meters, 2,500 tons per foundation, at a length of 120 meters, whereas today's limitation is 9 meter, with a length of 100 meter, and a weight of, so to say, 1,600 tons. So a substantial ramp up of the product size, a highly more efficient production process, and that will actually lead to a factory that will be second to none in worldwide, we believe, as far as we see it now, giving us the biggest monopile factory in the world. I think what's interesting to mention here, how is that financed? Because this is, as I said, a 330 million investment, and we were very keen to get big developers on board so that they describe the need for this factory and also commit to this factory by, on one side, helping us out on the finance. So, and on the other side, helping us out with launching orders at a price that justifies a payback period of 3 to 4 years. We've been successful in that with Equinor. Equinor has granted us a variety of orders, both in the US, which is a tricky one, to be honest, at the moment, given the US developments, but also in Poland for Baltic 2 and 3. And they did it at a good price, a price that justifies the investment. They paid 50 million euros as an advance payment for these projects. And on top of that, they have given us the cash in exchange of comprefs at a level of 50 million euros in exchange of a long-term capacity frame agreement. So they have a right to book more orders in the coming years, up to 2030-31 is the first period that it runs. Orders on an annual basis, basically 1 big or 2 big projects a year that they can place with us. And of course, that gives us also a certain base volume and a confident feeling that we are not only booking for the first startup, but also for the longer term. The second one is Shell. Shell has also paid us 50 million advance payment for the project they built together with Ecowende on the Kavel 6 of Hollandse Kust West. So that is also a booked project at a very strong price. And so in that sense, we are having, together with Baltic 2 and 3, a exclusive order still in negotiation that I unfortunately cannot disclose. Has given us a healthy order book at a good price with substantial financing at a total of 150 million for this new factory, which is, I think, very solid. On top of that, I like to mention that even if a contract will be cancelled or delayed, we have agreed with these parties very strong cancellation and delay fees and clauses that in depending on the timing when they make a cancellation could go up to the level of the complete contribution margin of that specific order. So also if something happens from a delay or cancellation perspective, we are covered partly or totally for the loss of contribution margin.
Yeah, very clear. And then, I think you already partly given it, but maybe could you give more building blocks on how you get to the 2025 financial targets, especially EBITDA of 135 million in 2025, so and 160 million after 2026. And you're at the level at 42 million this year, so yeah.
Yeah, I think that indeed there are 4 main building blocks that explain this quite aggressive, you could argue, EBITDA growth. One, of course, is the volume. It's pretty simple. If you go up from 200 to 500 kiloton theoretical volume, you get more volume in, meaning more EBITDA margin. The second building block, as mentioned before, is the price increase, so margin increase that we managed to include in our contracts. Unfortunately, I cannot tell you how big it is, but it's quite substantial, and we have been very transparent to our customers also why we need this higher margin. Simply, we need it to make sure that they get the capacity to build these bigger monopiles needed for these bigger turbines. So that was a very, I would say, well accepted sort of ramp up of margin. That's the second major building block. The third one is a building block is related to the efficiency of the production process that we have now, that we're building now. It will be a lot more efficient, leading to a situation that we don't need to ramp up the direct labor in the same way as you would do if you would copy paste the old factory setup. So a lot less direct labor cost because of a far more efficient production process, taking out a lot of, I would say, waste from a lean manufacturing perspective in, for example, transportation costs in between workstations and quality costs due to a better controlled process in general. So that's the third building block. And the fourth building block is, I would say, a very simple one. Even with this far bigger factory, there's still only the need for one CFO, one CEO, one sales organization. So the direct labor cost in relation to the old situation will increase somewhat because you need more support functions for this bigger factory, but not at a double 2.5 times size as the volume increase is developing. So those are the four main blocks that justify and actually underpin this EBITDA ramp up.
Very, very, very clear. So yeah, that concludes our interview. Thank you very much for the interview.
Right. Look forward to seeing you. Take care.
Take care. Bye.
Bye.